Policy types. So we have lenders policies and owners policies, obviously. Owners policies protect our buyers or property owners. And then lenders policies are protecting lenders and the priority of their loan against the property. Within those types of policies, we also have different types of policies. So I'm just going to pull up like a random title commitment. I can't figure out which screen I want to share. So you guys can see settler, right?
Mm-hmm.
Okay. So, oh, this random file doesn't have a title commitment because it's new random file. Let's just pick one of these. So, looks like this one is a cash deal, so we're only going to have an owner's policy because we don't have a lender that we're needing to issue a policy for. But in our commitment, it will specify like what kind of owner's policy we're issuing. So here on our Schedule A, where owner's policy is listed, we've got a standard owner's policy. So that's kind of just our normal owner's policy. That's what we issue most often here in Wyoming. So a standard owner's policy like this, the jacket to the commitment kind of goes over coverages and things like that. The jacket to the final policy also will go over like what types of things are covered on the policy. And then when we do a standard owner's policy, these exceptions, which are basically things that we're saying we don't cover because they're either known issues on the property or just risks that we don't cover. All of these exceptions stay on a standard policy. So any of like 1 through 10 are kind of like our standard ones that our underwriters determine go on every policy. So those all stay on the final policy. And then also like any of the property specific ones stay on the policy as well. So it's kind of just a normal policy. If you ever see here, if it lists extended or homeowners, Carm, are you done with your call? Do you want me to call you again? You're okay. There we go. Okay. Will you mute your microphone? Okay. So we were just talking about standard policies versus extended on owners. So an extended owner's policy, if you see that here instead, the jacket will look the same. The difference between extended versus standard is that on an extended policy, these first 10 exceptions get deleted. So these standard exceptions from our underwriter get deleted off the policy. And so that therefore increases the coverage that these people are getting because they have less exceptions on the policy, if that makes sense. So those policies are typically a lot more expensive and our underwriter, they require underwriter approval always. And the underwriters want to see what's called an ALTA survey, which is basically like a really, really detailed, intense survey. They'll even go so far as to mark like utility lines, like parking spaces, like every little detail about the property gets noted on these ALTA surveys. So because of the cost, not only of the survey, but the premium being quite a bit more expensive, we typically only see people request extended owners policies on super expensive commercial deals. So things like hotels, gas stations, hospitals, like big projects. Then you'll, especially if an attorney is involved, which a lot of times with those big projects, an attorney is involved, then you might see those attorneys request extended owners policies. So they're pretty rare. There is another version of what they call a homeowner's policy instead of a standard owner's policy. And it's basically an extended policy, but it's designed specifically for residential homes instead of these big commercial deals. Um, Again, it's a little bit more expensive, but there's not as many hoops to jump through to get the property approved. Um, but fewer properties like qualify automatically for the policy. So, um, to be eligible for a homeowner's policy, it has to be a property with a home on it in a platted subdivision. Uh, so like like lot 2 of Honeybee Meadows or something like that. If it's not in a platted subdivision with a house on it, it just can't have a homeowner's policy. It has to have a standard policy. And the reason why our underwriters are willing to give more coverage for those kinds of properties, like a platted subdivision with a house on it, a lot of times those just have a way lower risk of having a title issue. We know a survey's been done because the surveyors filed a plat. And so they're willing to give like the better extended coverage to these residential homes because we know that the risk is low. So the minor difference within a homeowner's policy, so again, it will be extended in that these first 10 endorsements are deleted, but also like the jacket on those homeowners policies is a little bit different. They have some like extra coverages for homeowners for things like fence removal if the fence isn't on the boundary, or like a few little things like that, that are kind of nice perks for paying more money for that policy. These policies are also super rare in Wyoming, the homeowners policy, because a lot of properties don't qualify. We just don't necessarily have a ton of platted nice subdivisions in Wyoming. We're just still very rural. The other reason is that our standard Wyoming purchase contract that our realtors are using. So let me see if I can find one that has. We have a lot of for sale by owners right now. So this will be a file that has a standard Wyoming contract. The default language in a Wyoming purchase contract that the realtors use just state that the seller will only pay for a standard policy because that's like the cheap standard level of coverage. And so it's just built into the contracts that that's the type of policy that will be purchased. So if we come here to title. I need to find the section, so give me a minute. I should have been better prepared. Hang on, give me a minute. Title. Insurance. Hang on. Oh, here it is. So seller agrees to furnish at seller's expense an owner, a current commitment for an owner's title insurance policy in the amount equal to the purchase price. So here just says that a policy will be issued, and it's assumed standard because it doesn't specify otherwise. In the Utah purchase contracts, they came from Utah. Their their default contract specifically says that if the property qualifies, a homeowner's policy will be purchased. And then if it doesn't qualify, then a standard policy can be purchased. So in Utah, we see those kind of fancier, more expensive homeowners policies a lot, just because the contract says that if the property qualifies, that's what will be purchased. That's not the case here in Wyoming. So anytime we're asked to issue an owner's policy, we assume standard unless somebody specifically states otherwise. And like I said, I don't know that I've ever done a homeowner's policy in the 4 years I've been here in Wyoming. I have done a few extended policies, like I said, on those big commercial deals. So,
Hi, Lee.
Yeah.
We did one for Jacob at Star Valley
Oh,
Ranch.
but Jacob knew specifically to request it because it was your son, right?
Yes.
So,
And one of the good things about the homeowner's policy is it provides fraud prevention if someone tries to sell the title of their property. So it may be something that in future we may want to promote,
yeah,
but we'll talk about that later.
right. Okay. So that's owners' policies. Lenders' policies are going to be really similar. Um, so let's just find one of these. See if I can find like a refi here. Um, so lenders' policies are going to be super similar in that we have standard or extended, and they also, as far as the difference of standard versus extended, are the same. A standard policy has the normal jacket and all of the exceptions, including those 10. An extended policy will have the same jacket but delete these 10 exceptions. Um, we do treat owners and lenders policies different though, as far as what we issue all the time. Lenders, the industry just expects an extended policy unless there's a reason why we can't do one. So we assume an extended policy for lenders always, unless they specify otherwise. Lenders' policies in general just have less risk of a claim, so our underwriters are agreeable to us doing extended lenders' policies, as long as we're not aware of a concern that makes that an issue for us. Um, so the most common type of issue why we might not want to do an extended policy would be if there's construction going on and we know that construction has already started, because one of these 10 exceptions is what we call the mechanics lien exception, where we're saying that we're not covering liens for labor or materials. So basically liens for construction, right? So on a standard policy, this exception stays, and we're saying we're not covering mechanics liens. On an extended policy, this gets deleted, and we are covering mechanics liens. So that's why we're so worried about when construction is involved. Can we do an extended policy or can we not? It depends on whether construction has started or not, right? So, um, so that would be if you're aware of construction being involved, we may not be able to do an extended policy. We need to look into that, right? Um, so in that case, like maybe we'd offer them a standard policy, or we potentially could offer them like an extended policy with modified mechanics lien coverage. And we'll talk about that more in just a second here. The third type of policy that we have started offering in the last couple years in here in Lincoln County is what we call a star policy. And those are specifically on Old Republic as the underwriter. Um, I'm trying to remember, I think we was this one that we did a star policy on. Yes, okay. Yes, this was a star policy. So what a star policy is it is a standard policy, but we have extra exceptions that we put on, that our underwriters put on those policies to like limit the coverage even a little bit more. And so they're kind of like a slimmed down version of a policy, and they're a little bit cheaper because of that. And so we really only offer them for lenders that are doing like home equity lines of credit, and they want like a junior policy, which we don't do junior policies. So it's the reason why lenders like junior policies for their HELOCs is that they're really cheap. So the star policy is like a good option to offer them as a substitute because they're super cheap, but better coverage than a junior policy, but not as good of coverage as a standard policy. So it's kind of that compromise in between. Um, So I'll show you on this Schedule A for a star policy. We'll see it says star loan policy instead of standard. And then Susan puts, there's extra exceptions here towards the front of the exceptions that are star policy exceptions that Susan will throw on the policy. Okay. Any questions about standard versus extended, the star policy with the lenders? I guess I'll just mention again, Old Republic is the only underwriter that offers the star policy. So if a lender, I know we normally put refis on Stewart. If they're requesting a junior policy or a star policy or whatever, we put those on Old Republic so that we can use this star policy option. Okay. So then the last thing we'll talk about today is, say we're in a situation where we do have construction started. We know we can't do an extended policy or a normal extended policy, right? But our lender also doesn't want a standard policy where they just have no coverage at all. Our underwriters do have an option where we can do an extended policy, but we add on what they call the 32 and 33 endorsements. So, what those are, we'll pull this up here. So this was an email from an underwriter, kind of explaining the 32 and 33. So we'll go through that, but, basically what they are is they're companion endorsements that just modify the mechanics lien coverage on our policy. So on a normal extended policy, we're just offering full blanket mechanics lien coverage. The 3233 basically throttles that down to a level that our underwriter is comfortable with. So the 32 endorsement that's issued first up front with the policy, how I like to explain it to lenders is it just modifies what mechanics lien coverage we're giving them. So we're not giving them blanket for all mechanics liens. We're giving them coverage specifically for items that are paid for in a construction draw, basically. So, here, I mean, he kind of laid out like exactly in the language that's in the endorsement what the 32 does cover. So it covers if the mortgage or construction loan is like not enforceable for is not enforceable as a valid lien against the land. That's standard for like all lenders' policies. The lack of priority of the lien for any like work that was paid for in a construction loan advance or a construction loan draw. So we're basically saying your loan for sure has priority over any work that you as the lender pay for in a draw. And then it looks like there's a little bit of coverage here for certain mechanics liens that potentially weren't filed in the public records. But basically what it is we're saying any work that occurred before your loan is in place, we're not covering those things. So if the borrower went out and poured his own foundation and did his framing, and that was all done before your construction loan was in place, we're still not willing to cover that. But anything that takes place after your construction loan started and that you, the bank, paid for with your draws, we will cover those things. So like I said, I like to explain to lenders like it's modified, kind of partial mechanics lien coverage. It is really, the Alta 32 endorsement is really expensive. It's like $1.50 per $1,000 for the loan. Yeah, so for every $1,000 of the loan amount, the premium is $1.50. The couple files that we've done, the 32 endorsement cost almost as much as the whole policy, like it almost doubled the cost of their policy. So, but the 32 endorsement can't be issued by itself. The way it's written and designed, it needs the 33 endorsement paired with it. And what the 33 endorsement does is it basically says, okay, lender, as of this date, you've issued, say, $50,000 in your draws. So your coverage for mechanics liens is now up to $50,000 and as of this date. And then say, a couple weeks later, they issue another draw and now they're up to $150,000 that they kicked out for construction. Then they request a new Alta 33. We issue another one, and that new Alta 33 will say, okay, now your coverage is $150,000 and this new date that's further along. So as they go through the process, they get more Alta 33s that gradually increase their coverage amount based on how much money they've actually kicked out for construction to that date, if that makes sense. So when you have a lender that you're going to do an Alta 32, 33, you'll charge them for one Alta 32. And then we can kind of give them the option. Do they want to pay for like a certain amount of Alta 33s up front, right at the time of closing? So say, for example, they're expecting construction to take 6 months and they do roughly one draw a month. They might want to pay for 6 up front. Or we can charge them for each Alta 33 as they go and just send them like fresh invoices every time they request an Alta 33. Those are also kind of expensive. Each Alta 33 is $150. So if you figure you've got a 32 that we already know is expensive, and then most construction loans plan on roughly a year. So 12 out to 33s, 12 construction draws over a year at $150 pop is, another grand plus. So this option does get expensive. Underwriter or lenders don't love it. It requires underwriter approval, lien waivers, all sorts of things. So, but it's the only option that our underwriters are willing to offer for these broken priority deals that are really far along or really big, expensive projects. So just to help you be more educated about that, like, if you do run into a situation where that is our only option, you're going to have to be educating your loan officers, like, what does it mean? How is it different from a normal policy? And why is it so expensive? So any, does that help to like understand those endorsements going forward? Any questions?
I thought I had one, but I'm looking now, sorry.
You're okay. I'll include this email with it's hard. This email's kind of in underwriter language, attorney underwriter language, but I mean, kind of the gist of it is the 32 is modified mechanics lien coverage that only covers items that are paid for in the lender's construction draws. Everything that occurred before the loan, not covered. And then those 33s increase the amount of coverage each time they make a draw and kick out more money. So,
And Dylan, I have this in regular language, not underwriter
Perfect.
language.
It's kind of similar
or
to that
else-
form we created.
Sometimes it's easier
guys,
if
not
you
me.
need a script, to put this in ChatGPT and have it, put it in a script that you can explain it to lenders. And the lenders get to decide how many Alta 33s they want. So, I think it's best practice to have at least one a month, but if they don't want to pay for that many, they could do one every 2 months. But that's up to
draw.
them. There are some lenders, they might only want to do it once a year, but they probably need a few because it increases their coverage. Because at the very beginning, the lender's like, we're not going to cover you for the full $250,000 because you have not paid any monies. So until you've paid $100,000, we're not going to cover you until you get that Alta 33, show that you've paid the $100,000. and then we'll cover you to that amount. Does that make sense?
And the draw is just the lender giving them money for this construction loan to build the house.
Right, so I don't know how familiar you are with construction loans or how those work. So how most lenders work is, say they're borrowing $400,000 to build their house. So the lender doesn't just give the buyer or the borrower a $400,000 check and say, go build your house.
Mhm.
There was too much like fraud going on with like borrowers running away with the money and not building a house. So lenders have got smart and figured out a way to like ensure that their money's actually being used for what it's being borrowed for. So the lender might kick out a little bit of money at first for closing costs, say, we'll cover all your closing costs as part of the loan. So they owe $5,000 at closing for closing costs. So the lender will kick out that first 5,000. Then the borrower has to go, or his contractor, whoever has to go hire the excavator and the concrete guy and the framing guy or whatever, and they get started on the house. And those people then give invoices and say, hey, I poured your foundation, here's my invoice. Hey, I did your framing, here's my invoice. The borrower has to go back to the lender then and say, here are my invoices. Here's my pictures proving I poured my foundation and I framed or whatever. Some lenders even go so far as to do a property inspection where they go out and make sure that the foundation and framing are really there. And then the lender will kick out money to pay those invoices. And most lenders will say, I'm not going to give you, the borrower, the money and you go pay the invoice. They're going to send the money directly to the concrete guy or directly to the framing guy and pay those invoices. And so they call that a draw. So anytime the borrower turns in invoices and then the lender processes that and kicks out money, they call that a draw. And so most lenders will say like you can do a maximum of say 2 draws a month, maybe. So at the middle of the month and at the end of the month, any invoices the borrower accumulates, they turn those all in at once. And the lender cuts a bunch of checks at once after they go through, their approval procedure. So that, like I said, that's called a draw. And so the way the Alta 33 is designed is to kind of be issued once with each draw because, okay, lender, now you've kicked out kind of a significant amount of additional money. We'll give you additional coverage. But like Carm was just talking about, they're expensive. They're $150 a pop. So we may have lenders that say, you know what, I'm okay kind of maybe doing one every other draw or one every third draw and just taking my chances in between to try to save some money and be more economical. And if that's what our customer wants and is willing to pay for, like we're gonna accommodate that. So
Okay, on that first, where it says Lori, thanks, at the end of that paragraph, it says that the Alta 33 is issued with each draw brings the date of coverage forward, as in like to that draw.
yes, yes.
So
So
everything after that is good.
what it's saying is because the way a policy is designed is it covers against things in the past, right? We don't provide like forward coverage. So if, for example, we're saying, Kate, you paid the plumber, I'm ensuring that if the plumber files any liens, you're covered. Well, our policy was issued on the date that the mortgage was originally recorded. So say that was January. Here we are now in March and they paid the plumber and they're requesting an Alta 33. In order to like cover that plumber, we also have to bring the date forward past when the plumber worked. So that's how it's designed, is it brings the date forward to match the draw so that then that work that occurred in that in-between time period is covered. So,
Okay.
yep. Okay, that is it. Carm, will you send me that like plain language summary and then we can maybe just include it in the email with this and with the recording? And we'll go from there. So
That sounds good.
good luck this week, everyone.
Thank you.
Okay, and recording. Hang on.